Welcome to Taking Stock for the week ending the 22nd of July 2022. I'm Kien, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share markets. Thanks for your time today, Matt.
Thanks again for having me, Kien.
And before we get started, though, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile, so any charts and tables presented should not be relied upon as a guide for future performance. Well, Matt, it's been a positive week for the share markets with both quality and growth stocks rebounding strongly. And you can see this with the chart on screen, which shows the ratio of Australian growth versus value stocks. And when the line rises, it means growth stocks are outperforming value and vice versa.
Yeah, we're certainly enjoying this recovery for growth stocks to start the new financial year. And it does seem that the market has priced in the risks around future inflation and interest rates and are now paying increasing attention to corporate announcements and results, especially with the start of the second quarter reporting period in the US. And despite heightened risks around inflationary pressures, supply chain constraints, and rising interest rates, there are early indications here that suggest that companies are performing better than expected, with about 60% of the companies reporting earnings above consensus estimates so far. But I do stress that it is quite early on in the piece, and we are awaiting some big tech results next week for a little bit more insight. To this point, and unsurprisingly, we have begun to see a deceleration in earnings growth rates, with the second quarter earnings only expected to rise by about 4.2% compared to its 10-year average growth rate of about 9%. And of course, the reason for this is due to those macroeconomic headwinds, higher energy costs, supply chain disruptions, labour shortages, the Ukraine invasion, and that softer economic environment. So inflationary pressures are always going to have an impact on operating margins in aggregate. But what we're seeing in the current quarterly reporting period in the US is that there are some quality companies out there that are managing their margins in this environment quite effectively. And of course, there are some companies out there that are clearly going to struggle. So we expect to see volatility in the weeks ahead, but it is pleasing that we're observing an increasing appetite for these quality businesses that are reporting solid operating results.
Yeah, meanwhile, Matt, in Australia, earnings expectations have begun to unwind, most likely driven by analysts revising earnings estimates on the back of the recent declines in commodity prices such as iron ore and oil. And you can see this with the chart on screen, which compares the Ords index in blue with its 12-month earnings forecast in black. And the black line is starting to roll over now. But looking towards the Australian reporting season, we expect cost pressures and supply chain constraints to be the ongoing theme. And we've already seen this issue arise with recent earnings downgrades from automotive parts supplier and borderline star growth stock and star income stock GUD holdings, and also salary sacrifice company Suncorp Group.
And we're also seeing this issue play out across resources. And this was prevalent in the quarterly updates from miners, Rio and BHP, who both highlighted rising costs from supply chain issues, heightened energy prices, and labour shortages. In fact, Rio and BHP provided a cautious tone to the iron ore outlook due to headwinds facing China's recovery from lockdowns and increasing risks that the rising interest rates could subdue demand for steel. Meanwhile, China is trying to mitigate these risks by forcing their banks to bankroll its vulnerable property developers so construction can continue.
Yes, of course, but we will be monitoring these active risks very closely in the months ahead. But for now, both companies are expected to generate significant cash flow to support their forward gross dividend yield of around 16%. Remember, both companies are low-cost producers, and the iron ore price will really need to fall below $50 a tonne before profits are eroded. But during the week, many of our star resource stocks also reported their quarterly updates. And from a production perspective, the best performance came from gold producers, Northern Star, Alkane Resources, along with Woodside Energy, and also Deterra Royalties as well. So please refer to our commentary for further information.
And these rising interest rate concerns are obviously having an impact on the retail sector, and many analysts are paring back their earnings estimates moving forward. And this did include star income stock JB Hi-Fi. And it's not a big surprise to experience a pullback in their earnings, given the extraordinary profit growth that they incurred over that pandemic period. So a normalisation of sorts is underway with regards to their future earnings.
However, Matt, JB Hi-Fi has been able to defy market expectations reporting sales growth for the year, which was 5% ahead of market expectations. And the earnings surprise was driven by this impressive end to the financial year, with June quarter sales climbing 11% on a like-for-like basis as consumers returned to stores on the back of easing restrictions. In addition, the company grew its online sales by 53%, and this higher margin segment now represents 17.6% of total sales.
It really was a terrific update, wasn't it? But the stock has triggered an exit on the SD30 TSR and SD Max, so trend-sensitive investors should remain on the sidelines for now. However, the strong result has created a catalyst for a stabilisation in earnings and support its gross dividend of about 9%. JB Hi-Fi has been a highly shorted stock in the past, but positively, we have not seen a significant rise in short interest in the stock over the last few months.
And another company to provide a performance update for full year 22 was Star Growth Stock and Star Income Stock Jumbo Interactive, an online provider of lottery tickets. Now, the stock was sold down due to the softer than expected outlook guidance, and we've already begun to see a downward revision to its earnings estimates. But trend-sensitive investors will need to be mindful that the stock has triggered an exit on both the SD30 TSR and also the SD Max.
Yeah, it was a miss, Cam, but it wasn't a big miss. So we certainly think that the share price weakness is very much overdone. And the earnings and cash flow is expected to grow strongly in the coming years and providing support for its modest dividend with a gross yield of about 4.2%. And also reassuringly, the CEO, Mike Veverka, continues to hold a large stake in the business at about 14.2%.
Okay, and now looking at the week ahead, our Star Resource stocks will continue to release their quarterly updates. I know Rio Tinto should release its half-year result on the 27th of July, but most of that's out now, while brain health company Cogstate has an update the day after. And also across to our technical alerts for moderately trend-sensitive investors, Pinnacle Investment Management, they triggered a re-entry on the SD30 TSR after it released better than expected performance figures. Meanwhile, no trend changes were observed on the SD Max. This week, we put the spotlight on the Australian banking sector following news of the potential acquisition of Suncorp's banking division by ANZ for around 4.9 billion, or roughly equating to 8% of ANZ's market capitalisation. Now, from an earnings front, the impact is expected to be neutral this year, although the deal is forecast to lead to a 5% rise in EPS into the future. Now, although there will be integration costs, the benefits should fully offset these costs. And these benefits include gaining a strong market position in Queensland and cost savings from having greater scale and being able to share their systems. In addition, the return on equity should improve because the combined bank will be able to hold less capital against its home loans.
For Suncorp shareholders, the deal represents an attractive price at about 1.3 times net tangible assets. This compares to the current value of Bank of Queensland and Bendigo and Adelaide Bank, which are trading at around 0.9 to 1 times NTA. So Suncorp stated that it intends to return the majority of the proceeds to shareholders. So this could mean a special dividend could be on the way at some point in the coming 12 months. Even before the sale of the banking business, though, analysts were anticipating a fairly healthy dividend per share of about 45.5 cents, which will likely go ex-dividend towards the end of August.
Yes, and the forward gross dividend yield looks attractive too, but we just got to be mindful of this divestment in the business. Not surprisingly, Suncorp will become a pure insurance business. And although this means that its earnings are less diversified, it will be more leveraged to the insurance cycle. And over the year, the higher insurance claims could mean that reinsurance costs could increase as well. But the company can mitigate this margin risk by increasing premiums themselves. In addition, Suncorp benefits from a rising interest rate environment due to its large bond investment portfolio. But Matt, a number of shareholders may be wondering whether the significant purchase by ANZ would jeopardise its dividend payment.
And it's a good question. But first of all, ANZ is actually raising $3.5 billion of new equity to help fund this transaction. with only about $1.5 billion coming from existing cash holdings. And in addition to that, ANZ is committed to maintaining its dividend payout ratio of about 60 to 65%. And with earnings expected to rise 5% in coming years, the deal is expected to support a high dividend profile into the future. And in addition to that, the deal will increase the proportion of franking dividends paid by ANZ.
And despite the integration risk, Matt, the deal does make logical sense, but will be subject to regulatory approval from both federal and Queensland state governments, including the ACCC as well. But currently, ANZ is on an attractive gross dividend yield of 9.5%. On the back of the potential acquisition of Suncorp's banking division by ANZ, a useful question for bank investors this week is, should ANZ investors take up the entitlement offer? Well, ANZ is issuing 187 million new shares, which is roughly around 6.7% of its total shares, to raise roughly 3.5 billion. In other words, one new share will be issued for each existing 15 shares. But to raise this money, ANZ has opted for a pro-rata accelerated renounceable offer. What this means is this structure allows investors to subscribe to the new shares in proportion to their existing holdings and sell the right to the offer if they choose not to take it up.
And the new shares are being issued at a price of $18.90, which is about a 12% discount to the last traded share price for ANZ. For mum and dad investors, the retail offer does close on Monday, the 15th of August. Now, if ANZ shareholders don't choose to take up their shares, their entitlements will be sold into a shortfall book build between July 21st and August 8th. The price that the bidders will pay for these entitlements will largely be represented by the difference in share price of ANZ at the time of the auction and the entitlement offer of $18.90. Now, if the ANZ share price does slip below $18.90, then it's unlikely that their entitlements will be worth anything.
And so, should shareholders take up the entitlement? Well, it depends on whether you believe Australia will move into a recession on the back of the aggressive interest rate rises, which could lead to lower mortgage growth and higher bad debts, and of course, erode the bank's profitability.
But we believe with unemployment at record lows and a fairly unstretched payout ratio of 69%, that the dividends for ANZ remain sustainable, at least for the remainder of the year. So with this in mind, the offer price of $18.90 represents pretty good value because it translates to a gross dividend yield of about 10.9%.
And also, Matt, if the deal is approved by the regulators, then income investors should benefit from additional franking credits and also the potential for a 5% boost to its earnings and dividends in coming years. Well, that's all we have time for again. And thanks, Matt, for your wonderful insights.
Thanks for having me, Kien, and hopefully the rally continues.
And also a reminder for our members to attend our Lincoln Live webinar on Monday, where our Chief Investment Officer, Tim Lincoln, yourself, Matt, and our Stock Doctor expert, Rob Manfrey, and myself discuss the market strategies and also answer your questions on stocks. So to summarize today, growth and quality stocks have shown signs of a recovery, but to ensure the recovery is sustainable, investors should monitor announcements over the reporting season to see how well their star stocks are managing inflationary cost pressures. Many star stocks have been sold down, but solid updates from companies like electronics retailer JB Hi-Fi and also logistics software provider WiseTech could represent opportunity. Take care and have a happy, healthy and prosperous week, everyone.